U.S. equities fell on Monday as investors processed the first of a week's worth of economic data and pondered what recent data might signify for Federal Reserve policy. The S&P 500, GSPC, lost 1.8%, while the Dow Jones Industrial Average, DJI, fell 1.4%, or about 480 points. The Nasdaq Composite, IXIC, which is heavily weighted toward technology, lost 1.9%. The release of the Institute for Supply Management's ISM Services Index kicked off the week's economic agenda. The indicator expanded more than expected in November, reaching 56.5 from 53.5 expected and exceeding October's reading of 54.4, indicating a still strong services industry. In a separate report, the Purchasing Managers' Index, PMI, fell to 46.2 in November, from 47.8 in October. New company activity has dropped at the fastest rate since May 2020. The Producer Price Index, PPI, which gauges prices paid for products and services before they reach consumers, will release new readings at the end of the week. The latest data comes on the heels of a stronger-than-expected jobs report on Friday, which sent equities into a wild ride. The strong job increases and salary growth are the polar opposite of what the Federal Reserve wants to see in its fight against inflation. The data released on Friday revealed that labor demand remains out of balance with supply, indicating that the Fed may either raise rates sooner than expected or keep them in restrictive territory for longer. After 4 consecutive 75 basis point rises, the narrative from U.S. central bank officials, who are now in their pre-meeting blackout period, has suggested they will downshift to a half-point raise at their December 13-14 meeting. Investors are now wondering how long the Fed will continue its tightening campaign, how high the federal funds rate will wind up being, and how long it will remain there. It's fascinating that the market is currently focusing squarely on the very strong likelihood that we'll ratchet down to only a 50 bits per second hike next week and extrapolating that level of dovishness rather than any risks that the terminal rate could end up being closer to say 6% than 5%, Jim Reed and colleagues at Deutsche Bank wrote in an early morning note Monday. Meanwhile, another batch of third-quarter profit numbers will be released, bringing the reporting season to a close. The yield on the benchmark 10-year Treasury note rose back above 3.5%, while oil prices plummeted as further restrictions on Russian energy were implemented, with WTI crude trading at $77.33 per barrel. OPEC+, or the Organization of the Petroleum Exporting Countries and its partners, including Russia, maintained its output curbs on Sunday. The decision made in October was confirmed at a meeting on December 4, just before the implementation of a $60 price restriction on Russian-origin crude oil reached by the EU, G7, and Australia. Tesla, TSLA, shares fell 6% in early trading after Bloomberg reported that the firm plans to curtail production at its Shanghai factory, the latest indicator of sluggish demand in China. Stuart Butterfield, co-founder and CEO of Slack, is stepping down in January, only a week after co-CEO Brett Taylor announced his resignation. Lidiane Jones, a longtime Salesforce cloud executive, will succeed him. The announcement comes less than 2 years after Salesforce paid $28 billion for Slack. Salesforce, CRM, shares fell 7% on the news. Morgan Stanley analysts believe 2023 will be the Goldilocks year for airline equities after 3 years of volatility. United Airlines stock jumped nearly 3% after Morgan Stanley upgraded it to overweight. Overseas, Asian markets rose on Monday as local Chinese authorities relaxed some of their rigorous COVID restrictions in response to public demonstrations last week, which resulted in a significant shift in Beijing's commitment to its zero-COVID policy. In other news, Sam Bankman-Fried, the founder of FTX, has stated that he will testify before the House Financial Services Committee after learning and examining what transpired in the collapse of FTX.